Inflation is a quiet force. It is the gradual rise in prices for goods and services over time. It is a concept that sounds academic, something discussed by economists on news channels. But it is not just an abstract idea. It is a real and tangible presence in our daily lives. Inflation means that the dollar in your pocket today will buy less tomorrow. It is a slow, almost invisible erosion of your purchasing power. You might not notice it from one day to the next, or even 1 month to the next. But over years, and certainly over decades, the effect is profound and undeniable. It changes the value of your savings, your income, and your future. Price tags from then versus now tell a powerful story. Purchasing power is the real measure of your wealth. It is not about how many dollars you have, it is about what those dollars can actually buy. Inflation is the direct enemy of purchasing power. When prices go up, each dollar you own becomes weaker, capable of acquiring a smaller slice of the world's goods and services. Imagine a favorite pizza that costs $20. If your income stays the same and inflation raises that pizza to $22 next year, your money has effectively become weaker. You can no longer afford the same simple pleasure without spending more. This is how inflation makes us feel poorer, even if the account balance looks the same. With a steady 3% inflation rate, the math is straightforward but startling. Next year, about $3.09. 5 years, about $3.48. 10 years, about $4.03. 20 years, about $5.42. The price nearly doubles while the coffee does not change. This slow creep is deceptive. We adjust and absorb small increases. In a world with inflation, cash is not a safe haven. It is a guaranteed loser. This is one of the most counterintuitive ideas in personal finance. We are taught to think of cash as the ultimate form of security. It is tangible. It is simple. There is no risk of it crashing like the stock market. But this perception of safety is an illusion. While the nominal value of cash is fixed, a $20 bill is always a $20 bill. Its real value is constantly in decline. Every day, cash in a checking account or under a mattress buys a little bit less than yesterday. It is a melting ice cube, slowly but surely losing its mass. Holding cash during inflation is like standing on a downward moving escalator. To make progress, or even to stay in place, you must walk upwards. Simply standing still means you are going down. If inflation runs at 4% and savings earn 1%, you are still losing about 3% of purchasing power. Historically, cash returns have trailed inflation over meaningful periods. We fear flashy volatility, but ignore the quiet, certain loss from inflation. This does not mean zero cash. Keep liquidity for bills and emergencies. The first and most fundamental move to combat inflation is to become a disciplined and strategic saver. Create a plan to set money aside and place it where it can try to keep pace with rising prices, a high-yield savings account. It rarely beats inflation, but it reduces the damage. Research banks, especially online, and find the highest APY. Open online, then automate transfers every payday. Even 50 or 100 a month adds up thanks to compounding. Build your 3 to 6 month emergency fund here. Consider certificates of deposit for money you will not need for a set term, often higher rates without market risk. Use savings and CDs as defense, not a get-rich plan. This creates a stable base for long-term investing. Without intentional saving, investing rests on shaky ground. Saving is about defense, but investing is about offense. To truly beat inflation, your money must grow faster than prices. That is the purpose of investing. Invest in assets that can outpace inflation. For most, stocks are the most accessible. A stock is a small slice of a company. As companies grow and profit, your stake can grow. Historically, stocks have beaten long-term inflation. You do not need to pick individual stocks. Use low-cost index funds or ETFs. They track major market indexes. Buy one S&P 500 fund, own pieces of 500 companies. Instant diversification. Focus on time in the market, not timing the market. Use dollar-cost averaging. Invest the same amount monthly. You buy more when prices are low and fewer when high. Small, consistent contributions compound into real wealth. Open a Roth IRA or brokerage in minutes and start with small amounts. The most important step is to start. Earlier money has more time to compound. Practice intentional spending every day. Align money with your values. Insert a waiting period for non-essentials. Choose durability and value over cheap and disposable. Think of your parents or grandparents. Their prices sound like fiction, but they are data points. A new car for a few $1,000s. A house for what a down payment costs today, a candy bar for a nickel. The milk has not changed, the container has not changed, the money's value has. Bury $100 for 20 years. It is still 100 on paper. But what it buys is dramatically different. Inflation steals value, not the bills, but what they represent. Understanding this is the first step to protection. Plan for future goals and future dollars, or you will face a shortfall and a moving target. Ignoring inflation is like filling a leaky bucket. You must pour faster just to stay even. Inflation is powerful, but not a financial death sentence. Meet it with strategy, discipline, and knowledge. You cannot control inflation, but you can control your response. 3 core moves: saving smartly, investing for growth, spending with intention. Shift perspective. Cash melts. The market is a long-term growth vehicle. Act now. Auto transfer $50, start a Roth IRA index fund, and wait 24 hours before non-essentials. Small steps, compounded over time, create freedom. Take the first step today. Like, share with someone who might benefit. Subscribe for more. Subtitles are available for accessibility.